Every single day, trillions of pounds, dollars, and euros move through the global financial system. The vast majority of that money is completely legitimate. But hidden among those millions of legitimate transactions are funds linked to fraud, corruption, drug trafficking, and other serious crimes. So how do banks stop criminals from making dirty money appear legitimate? The answer is anti-money laundering, better known as AML. Over the next few minutes, you'll learn what AML is, why it matters, and how financial institutions help protect the financial system from abuse. Hello, and welcome to Compliance Compass. I'm delighted you're here. Whether you're preparing for an AML interview, beginning a career in compliance, or simply looking to understand financial crime, you've come to the right place. Our mission is to make complex compliance simple, practical, and easy to understand. So let's navigate compliance with confidence. Let's start with the most important question. What exactly is anti-money laundering? Anti-money laundering, commonly known as AML, is a framework of laws, regulations, policies, and procedures designed to prevent criminals from disguising money obtained through illegal activities as legitimate income. In simple terms, AML is about stopping dirty money from appearing clean. Financial institutions, banks, and many other regulated businesses use AML controls every day to verify their customers, monitor transactions, and identify suspicious activity. Together, these controls make it much more difficult for criminals to use the financial system to hide illegal money. Think of AML as the financial system's security guard. Its role is to protect the financial system, businesses, and society from financial crime. Now that we understand what AML is, let's answer another important question. Why does anti-money laundering matter? Money laundering isn't a victimless crime. When criminals successfully hide the proceeds of crime, they can continue funding activities such as fraud, corruption, organized crime, drug trafficking, human trafficking, and terrorist financing. Without effective AML controls, illegal money could move through the financial system unchecked, making it easier for criminals to profit from their activities. That's why AML is about much more than protecting banks. It helps protect people, businesses, communities, and the integrity of the global financial system. Every customer verification, transaction review, and suspicious activity report contributes to making financial crime more difficult. To understand how AML works, we first need to understand how money laundering happens. Although every case is different, money laundering typically follows 3 stages. The first stage is called placement. This is where illegally obtained money first enters the financial system. For example, cash generated from criminal activity may be deposited into a bank account or used to purchase valuable assets. The second stage is layering. Here, the money is moved through multiple accounts, businesses, or countries to make it difficult to trace its original source. The final stage is integration. At this point, the money re-enters the economy, appearing to come from a legitimate source, such as a successful business or investment. By the time the money reaches this stage, identifying its criminal origin becomes much more difficult. So, how do financial institutions help prevent money laundering? The answer lies in a combination of skilled people, effective technology, and strong regulatory controls. The first step is knowing who your customer is. This process is called Know Your Customer, or KYC. Financial institutions also carry out customer due diligence to understand who their customers are, where their money comes from, and whether their activities are consistent with the information they have provided. Customers who present a higher level of risk may be subject to enhanced due diligence, which involves gathering additional information and carrying out more detailed reviews. Banks also monitor transactions, screen customers against sanctions lists, and investigate unusual activity. Together, these measures help detect suspicious activity and protect the financial system from financial crime. Before we finish, let's quickly recap today's lesson. First, anti-money laundering is designed to stop criminals from making illegal money appear legitimate. Second, money laundering usually follows 3 stages: placement, layering, and integration. Third, financial institutions use controls such as KYC, customer due diligence, enhanced due diligence, and transaction monitoring to help detect and prevent financial crime. And finally, AML protects much more than banks. It helps protect people, businesses, and society as a whole. Thank you for watching Compliance Compass. I hope this lesson has helped you better understand what anti-money laundering is and why it plays such an important role in protecting the financial system. If you found this lesson helpful, please consider subscribing to Compliance Compass for more practical lessons on AML, KYC, and financial crime. In our next lesson, we'll explore the 3 stages of money laundering in even greater detail using practical examples. Until next time, stay curious.